Welcome back to the Running on Grass podcast. I'm your co-host, Logan Pribbino, here with Eamon O'Toole. How are we doing this morning, Eamon?
I'm good, Logan. How are things in Nebraska today?
Man, so much different than a week ago. We've caught several rains, and it has drastically improved everyone's mood in southwest Nebraska.
Is it going to do enough good to be worth something, or is it just settle the dust?
It was really good. We've had over 2 inches in the last week. It's too late for the corn, so we're still going to be grazing that. So we're going to get off of the range onto our dryland corn, and it still will be good for the range. It should turn around. This place should look very different in probably by the weekend.
I think we've caught 2/10 in that same amount of time, which we don't need inches here that way, but it's not really enough to do any good here. Everybody gets excited about rain whenever it comes, but 2/10 doesn't really do much more than settle the dust at this point.
No, you are in a pickle, my friend.
We were talking about this the other day. I'm at a place where we had the driest summer anyone had ever seen last summer, and then to have the driest winter anybody had ever seen since maybe the 50s. But the difference was, as they said, after that dry winter, they had a really wet summer, and we have not had that. And we've had an even drier summer than we did last year. So 2 dry summers and a dry winter make for a pretty tough situation here in South Central Wyoming, Northwest Colorado.
You guys are in a multi-year drought, and those are always very difficult to manage through.
Well, I mean, we have stretched things out. We moved your cattle down to some country between bags and the mountains, and Chandler and I spent most of yesterday running around making sure everybody had water, putting out salt, and trying to get them spread around. Where normally we try to have one big group of cattle we're moving around more for management purposes than anything, and we've got them really spread around, trying to use every water source we have just to keep water in front of that many head of cattle at once.
Yeah, if you don't got water, you got nothing.
That's it. We had the great rains in April, May that set us up for grass, but the ponds weren't full, and we're totally living off of tanks right now. I went and looked at some country. I actually have a neighbors yesterday that we were looking at renting, and had 2 really good reservoirs. Historically, they're just awesome. And I walked down just to see what the entrance into the water was like, and I dang near got sucked in, and my dog couldn't even get a drink out of it. It was that soft. And so we decided we can't lease that piece of ground because the cattle would have been stuck. We would have just been trying to pull cattle out 24/7. So we said no on that.
That's wise.
Yeah, tough times. Droughts often lead to the best solutions long term. I had a guy ask me yesterday, why do we make decisions and where do we come up with some of these opportunities? And I would say a lot of our things that we do today or our biggest opportunities are because of things like this. We had a really bad winter or some sort of drought situation. Something happened that led to something really good long term. So I look at this as an opportunity for us to think outside the box and go find some possibly new pasture, some new opportunities somewhere else that maybe lead to an expansion or a growth mode. So I'm not going to get too down about it. I'm just going to try and think of how do we get out of this and create new opportunities.
Droughts are an opportunity. That's something that Wayne Faschholz on the WRN episode, we really talked about how he was able to utilize those as something positive.
Yeah, that's right. Anytime that we're faced with adversity, we need to look for the future and the opportunities, not get down about where we are.
Yeah. So what do you want to get into on the podcast today?
Boy, we've got a heck of a setup here. Sabota, expansion, heifers, capital and overheads, especially at the height of this cycle. So let's get into it.
Yeah, let me give our shout out to Eastco. Eastco is a rancher-owned, rancher-focused insurance agency specializing in PRF, and they want you to know that the range system for PRF is changing starting in 2027. If you're curious how this will impact your policy, even if it's not currently with Eastco, they're happy to just run an analysis and show you the numbers. Just reach out to info@eastcogroup.com to have them explain to you what is changing. Even if you're not signed up with them, they're happy to help you through it.
Get a hold of Jen and JW. They'll get you guys set up and heading in the right direction.
All right. How about a market update? What's been happening?
Boy, so I'll give you a personal shot of what happened to me last week. I was set to sell some couple loads of steers and some heifers. And that was the same day Tyson decided that they were going to close 2 plants with no previous warning. And boy, it was a shot, kind of a slap to the face. Prices were not good. I no-sailed everything that day. Sounds like at least 50% of the people selling that I've heard about no-sailed as well. So we've talked about this. There's too many other reasons for this market to not fall apart. We just don't have enough grass. We're all in a drought. There's not enough producers. We're losing ground every day due to development. There's just a lot of reasons why this market can't really fall on its face the way it did in 16. And I think that we as producers just need to sit down and ride this thing for a little bit, let the market settle out and see where this thing takes us rather than making drastic moves and maybe missing out on some good markets still to come.
That Jocelyn deal looked detrimental. Seemed to be more impactful than even the Lexington plant closing. I don't know why that is, but it was very clear that it leaked earlier in the week. Ahead of that announcement, the board was down heavily on rumors, as it does.
Interestingly, I had gotten to tour the Tyson plant up in Pasco, Washington, which they're trying to get sold. They're not just shutting the doors, but I think, did you say that was 3,200 jobs affected in Pasco? And yeah, I toured it. It's a beautiful facility, top tier. I hope somebody jumps on that thing and buys it. You look at Northwest Beef that feeds like 60,000 head of cattle or something at Northwest Beef feeders up there near Pasco. And that's going to really shift where do they send that many head of cattle every week. So I hope that somebody will come in and buy that place and be able to pick it up and keep it moving.
I hope so. It'd be good for everyone involved. I also think the markets are just the Mexican border reopening on August 24th at Douglas, Arizona is still the wall of worry is what Don Close calls it. And it's something that we're having to climb. Although I will preface this with, I shared with Eamon another article where an analyst was calling for higher highs still. Yeah, it was in Beef Magazine and it was Texas A&M University analyst Kay Ledbetter calling for higher highs still to come.
Like I said, there's no reason for this thing not to continue to get higher. We just have too many things that are pushing back and the numbers are so low and there's still a lot of people eating beef. It's not like everybody all of a sudden said beef got too expensive. People just decided that they were going to buy a little less of it maybe, or they are driving less in their car, but people are still buying a lot of beef, even though we keep talking about how expensive beef is getting. It's not like everybody just stopped buying beef. It's still going out the door at record pace.
It is kind of hitting the mainstream a little bit. I saw Zero Hedge, which is a very popular account on X. He posted about how the consumer is moving away from beef, claiming that pork is less than half price, which is true. I commented and said, if you're going to eat a lot of pork, look into pork and pork production because there is a very good reason that it is significantly cheaper than beef. And it's because it is not the same quality as beef. And even in how it's produced, you could drop the average consumer off in a hog barn and they'd be aghast.
That's right. And my dad wouldn't eat chicken or turkey. And he said, once you go into a chicken or a turkey facility, you can't eat that stuff again. And you come to your ranch or my ranch, you're like, wow, this is really cool. You guys got animals out grazing and they're, laying down, chewing their cud, enjoying their life. And you go to those pork and chicken and turkey facilities and it's pretty disgusting.
Even with our feedlot sector, I think it's totally different. Our confined feeding versus those of chicken and pork. It's a totally different animal, in my opinion. But anyway, back to the fundamentals. Jeremy Martin was here yesterday and we had our every other month meeting with the staff and everyone. And he had a master's student from UNL there tagging along, which is kind of fun. And he made the comment, the fundamentals indicate that we could have a high in 2027 or even 2028. But we know the market trades vibes. It does not trade fundamentals. So the fundamentals are looking strong, but the market seeks to embarrass the maximum amount of people.
Every week, it sure does.
Every week, yes.
Including myself. It was really great. I took my kids to this sale and I thought they had never been to a video auction sale before. So we go in there and they're trying to figure out like who's bidding, where are the bidders? Because it's all happening over the phone or over the internet. So I'm trying to explain to them and you can see the guys up front and where they're calling out the bids from. So they're starting to get it. And then we go and our calves, I no sale them all 3 loads. And they are like, well, what was the point of all of this? I was like, well, we learned that today was not a good day to sell and we'll regroup and figure out how we're going to remarket these and what we're going to do here. And I got home and I was telling my wife about this. And I said, long term, I think it was great for my kids to see me no sell. That was one of the best things that could have happened today because my kids were there. And it just shows you don't have to take what's given to you that day. This is a long game. We have a lot of opportunities. Sometimes your first loss is your best loss, but in a market like this, I don't think that it's worth taking that loss that day. I think that there's other opportunities. And I was trying to explain that to my kids, but I thought it was really great for them to see that you don't have to take what's given to you.
I think that is awesome that your kids got to see that. There are a lot of producers out there that we sell our ball and calves on the second week of October at the sale barn every year, and they just get ingrained and they don't think about marketing the way that you do. And that's why you hit those summer sales. Your back's not against the wall. You've got months.
Yeah, I've got a long runway ahead, and I don't have to really make a decision until sometime between a day and a week before my calves will ship in November. So long runway there, a lot of opportunity ahead of us. And that's how I look at it and how I explain to my kids what's going on in front of us for the future. So it turned out, even though we didn't sell, I think it was a great opportunity for my kids to see and learn those things. And they got to meet a lot of people from around the country that were there at that sale that were friends of mine from NCBA stuff. So that was pretty great too.
And David Hales, I shared with you the article that he thinks that in the futures market, Friday was a low, not a structural low, but just the market overdid it and is looking for especially the futures to rise in the immediate future.
Do you think that by letting the border get totally closed up and being so worked up about the New World screwworm, which I live in a place that I'm not worried about it, so it's easy for me to talk about it the way I do, but was it worth the change that in Mexico, they are building their own feeding capacity? They're building their own plants to slaughter these animals, and it's all going to be run by the cartel, as everything else that makes money in Mexico is. And now we're going to be importing box beef rather than live cattle. And what happens to the southern states that were bringing those live cattle in, and how do those ranches move on from here?
A lot of those southern feed yards specialized in importing those Mexican cattle. And I don't know. I try to be opinionless in matters like that don't really involve my skin. There are winners and there are losers. I try to look at the reality and try to position myself, and I can't see how it's going to affect Logan Pribino or Wineglass. I just finished that David Goggins book as I saw it, and he was really into politics and really into wanting to change through the political process to make it better for the U.S. ranchers in particular. And my dad always taught me, don't jump into politics and try to bend it to your will. Figure out what they're going to do and how you can capitalize on it. So that's kind of my philosophy.
That's a pretty great philosophy, and kind of sit back and see how the road is paved and how you can best navigate it. Personally, I'm just frustrated that the market has taken so many twists and turns with the New World screwworm, and the board is always shifting based on good or bad news. And it seems like they always find the littlest thing can make it bad news so that there's downs. And there's a lot more of that than there are highs.
It's more volatile. There's no doubt about that. That's true in the grains complex too. And it's just the world that we live in today. Our financial markets and our monetary policy support this idea of a casino more than a fundamental price discovery tool. I think that's just the reality that we live in. There are advantages and disadvantages, but in the money printing era and people making large bets, it's just a casino anymore. And you need to understand that.
And it seems like they almost don't realize that there's real people on the ground that are really running these animals in their bets.
I do believe that they took a vote for having the cattle on the Chicago Mercantile Exchange, and producers didn't want it because they could see what was going to eventually happen, which exceeded even what they thought was possible, I'm sure. To that point, though, Eamon has been our friend here for a while. We got to higher highs because the board pushed right through $3, it's $3.70. I don't think that without the board that, the fundamentals seem to sure support knocking on $3, and it sure blew right past it, as it does when it's a casino that's more of a financial tool than a price discovery tool.
Yeah, I agree with that. Let's get into all these really great questions that Weston has put together. And let's talk about key discussions that we want to hit on here. Like, what filters do each of you actually run a growth opportunity through? And is that grass capacity, debt service, labor, personal risk tolerance, opportunity costs, management bandwidth? I think we can hit on all of those. And sometimes those decisions are based on all of those things at once. But I'll let you lead us off here. And what do you use for your growth opportunity filters?
Sure. So we're going to call this the Sabota special. He's got the rest of the podcast episode here. Had some great questions. Really encourage you guys to reach out to us and feed us your questions. Our best segments come from our listeners and their suggestions. So we really want to know what you're thinking. And this is just another great example of some wonderful questions. So segment 1 here is going to be evaluating growth at the high of the cycle, which we certainly are at or near. And what do you do? Do you grow? Do you shrink? How do you decide what to do? And it is very difficult because it seems that there tend to be more growth opportunities at the top and fewer at the bottom. And how do you do it?
As I look at this, and obviously, if you don't have grass, you can't do anything. That doesn't mean that there isn't grass somewhere else. So maybe you don't have grass on your ranch, but are there opportunities somewhere else? You don't have to be stuck at home. I had a guy ask me yesterday, how big does the opportunity need to be to leave your home? And I said, well, if it's a place down the road, I will almost always lease it and I'll figure it out later. If the opportunity comes up, I'm going to jump on it because I can walk to it, I can graze to it, I can trail to it, those kind of things. I'll jump on those. But if it's going to be something like Logan Pribano's 7 hours away, it has to run enough animals that it's worth messing with. To send Logan 100 head is probably not my best opportunity at Ladder Ranch because it's too far away from home and there's a lot of trucking to get there. But when I send 300, 500 plus, I can break those numbers down and you start getting more bang for your buck because you've got more animals to spread those costs over. I guess I look at it first through that lens. Debt service opportunities are all about timing. And sometimes, like right now in a drought, you're looking for those opportunities, but we do have high interest rates right now. And I don't think that purchasing a place is your best opportunity right now unless it comes with some pretty good upside because the interest rates are going to be hard to keep up with. My personal risk tolerance is probably higher than most. And I think I was just born and raised in a high risk environment with the landscape we cover and the quantity of animals we run. You don't look at animals as, oh, I'm really sad that one died. You look at it as, well, we're under 2%. It's a numbers game more than it's a feel good game at that point. And then your opportunity costs are variable depending on how risk tolerant you are and how much opportunity you're willing to chase after. I'm sure that that's not the kind of question you're asking, but that's how I'm going to approach that one. And the last part is I do have a lot of management bandwidth here at Ladder Ranch. I have a sister who's very capable, and I have my main employee, Chandler, can cover a lot of ground. He doesn't waste a lot of time sitting on one problem. He kind of gets in, whips through and deals with it. And he's got people under him that he can give a certain amount of responsibility to say, hey, this is how I want you to fix this problem, go. And then he'll move on to the next problem, which I think he's learned from me watching me kind of run around because we're so spread out that I can't spend all day on one problem usually.
On to the next one.
Yep. So I don't like to think of it as we run around and put out fires, but some days that's what it is. And it's more managing people and making sure people are doing the jobs that are the most important that day. So that's how I look at that specific question of growth opportunity.
I'll tell you, my perspective on this is come straight from the horse's mouth, Allen Nation. He said, the correct play is to sell and shrink at the top of the cycle. It is the only thing to do at the top of the cycle. And he repeats it. And then the only thing to do at the bottom of the cycle is to buy and build. And as someone who shrunk at the top, I read that page a lot in the last few years. As you guys know, I just am a Allen Nation man, and we grew our cow herd and I was very proud of it. It was against my ego to sell when we did and how we did. And the other advice that Allen gives out is, when you're trying to time this, which knowledge ranching is about trying to time it. And you got to be the guy who sells when everyone says, oh, I think there's some juice left in her. And that's when you need to sell. So I reread that many, many times, and I would just echo that. We did sure grow in 2016 and 2017 after fumbling 14. And we've talked about this on past podcasts, but Wineglass really kind of fumbled 14, 15. But man, we did get 16 and 17 right. And we grew when it was cheap, and it made us look really good. We were not sitting on a lot of cows in 2016, and we expanded in the stalkers at the low and kind of built from there, and it worked out really well. So my opinion on evaluating growth at the high of the cycle is you just don't do it unless it's a once in a lifetime opportunity.
I think that's all spot on. What are your thoughts on neighboring places versus buying good females?
As you guys know, we bought a neighbor's place 2 years ago and we sold cows and we bought this property. So the timing was not great, obviously, but we did sell cows so we could pay cash for the property. The problem with this, Weston, is I can't decide when the neighboring property comes up for sale. The old adage is you get a shot at neighboring property once every other generation. So would I have liked to purchase that property in 2028, 2029? Absolutely. But I didn't get to decide that. So we had to jump on that opportunity when it came.
And I think you can always put something on that land until maybe those females you're hoping for come along. But anytime you get an opportunity to buy land and you can afford it, I think you should do it.
Yes. And we'll get into a little bit more on that when we talk about thoughts on working capital. I do have some more thoughts on that. But any concluding thoughts, Eamon, on evaluating growth opportunities and how it plays into where we are in the cattle cycle?
I can tie it up on my end with saying that opportunities are always about good timing, and your best opportunities hit when the timing works for your operation.
Yes, timing is everything, especially in cow-calf land. It trumps good management. To be completely frank, getting in and out of cows is way better than being a really good cow man. And that's solid advice from Eamon. You want to hit on risk management, how we look at risk management, in particular with our Bred Heifer program, was Weston's question. What have you done for risk management in the last couple of years?
Relied on this market coming up.
That has been the right play.
Logan and I go to a meeting every year where this is discussed. We go to the Cattle Facts meeting in December, and Logan and I sit there next to each other and we kind of pass notes back and forth all day and we listen to what they talk about. And that is where we make the decision on what kind of animal we want to run that next coming year. And the last couple of years, that animal to us has been a bred heifer, or a heifer calf to breed and sell a bred heifer, because we're seeing that there aren't enough numbers of cows having calves in the market. So that has looked like a good opportunity, and Logan and I have tried to capitalize on that. And I think that our timing on that's been pretty good the last couple of years. We haven't lost money, let's put it that way. And last year we did fairly well on it, seeing this huge rise in the market. So that's where the risk comes in. We kind of take some of that risk management and we put it into that day and what we learn. And Cattle Facts is pretty spot on most of the time. And so far that's done well for us. So I would say research and understanding what business you're getting into is a huge part of it. We're not just going out there winging it, hoping that fat steers are the play. We're doing some research on that. What do you think, Logan?
We use tools like hedging and LRP, a combination. We are mostly hedged. Right about where the market is right now is the average on our home raised steers and purchased heifers. Like I said, we use a combination of LRP and the futures. In particular for the bred heifer market, if you want to be fully protected on those, you probably need to own more than one per bred heifer if you're going to fully protect it. We've chosen not to do that. I think if you want to be, hey, I've got my risks laid off, you need to be like 1.5 contracts per pot load, essentially, because of the values that you're playing with. But we've just done less than 1-to-1. We'd be a 0.8. So we've got some risk out there. And I believe you need to be in a position, you can kind of get in them and get them out of them with this volatility. But I do think you need to hold a position to ride this down. Although it has been costly, we did hedge some for the first time in a long time last year, and it ate into my profit margins, to be frank. And this year might do it again, but I think one of these years having that hedge position is going to be very good for your margins overall.
I am not a hedger, and I've said it before on our podcast. It's beyond me. I don't feel confident enough in it that I understand how to not lose a lot of money in it. So I just don't play that game. That's something we've kind of generationally talked about, and we've played a little bit with it in the corn game. The other part is we don't live somewhere where there's good enough service all the time. That call comes in and you have to make a decision. We're often not around the phone where we have service 24/7. So that's also a little crippling in the hedging game for us. But one thing I'm going to do that's going to, I guess, take some of the risk out of it is, and Logan's been doing this, I think, we're going to probably start buying our heifers from ourselves. So our heifer purchasing business is going to start buying the heifers as replacement heifers that Ladder Ranch doesn't keep, because we produce way more heifers than we could possibly keep ourselves and want to calve and have the ability to. So there's a lot of really good quality heifers that Ladder Ranch sells, and I think we can keep those, and we have the facilities to manage those and keep those cattle here on the ranch. I think that's one thing. And we can pick a fair price that we think is actually fair rather than sometimes we're going and buying these heifers and people are just outrageous on what they think these heifers are worth. And I can go down the road and find equal quality heifers somewhere else. But if I'm getting them here, I'm taking trucking out of the equation, taking some of the feed sources out of the equation. I think there's some other risk market opportunities for Ladder Ranch there and keeping some of our own heifers rather than purchasing everything from other places.
Yes, and we do utilize that as well. Retain the heifers and grow your own. Homegrown are the best.
Yeah, and you know what you've got. That's the best thing about homegrown is you go buy cattle from 3 or 4 other ranches and you're trying to put these big groups like Logan and I are doing. And because we've been buying quality, I don't think either of us have been hit by any plagues or weird things that are out there that you can get from buying from other source cattle. But when you buy your own, you know what you got.
Yeah.
And you know how they should grow.
Yeah. I'll hit on one other thing that Weston asked, and then maybe we can talk more about some working capital questions. But Weston asked in particular, how much price protection feels enough when values are this high? And I can tell you, man, when the market is up, like when we were at 370, I was like, you idiot. What the F were you thinking? Why were you trying to protect price at all when this thing is on a ripper? But this is really important and good advice. You need to be firm in your position. If you hit the 370 and you're like, well, let's just get out of this thing. It's just costing me money. I actually had a friend whose banker called him and was like, this thing is costing you money every day. You need to exit your position, which is exactly the worst thing that you can possibly, if you sold them at a profit target and you get to 370 and your banker of all people tries to talk you out of your position, you can end up losing money on the deal because you had to pay the money on the way up and you're going to lose the value on the way down. And so you can get backwards really quick. So when you do take a position and it rips further, you need to do your best to stay in it because if it goes down, it can really rip your face off. And a lot of people trading wheat that sold wheat back in 2010s got in trouble with this. Their bankers and brokers had them exit their positions and it was sold at a profit target and they end up losing money because of the value losses. That makes sense. So that is all to say how much price protection feels enough when the market's down, when everything covered, and then when the market's up, it's like, why are we this hedged? So what position feels right depends on the day.
I remember saying, I'm thinking about hedging at 370, whatever. And what an idiot. Like, what was I doing? I should have been like, if it gets better, great. If it doesn't, then this is a great insurance program. It hung around 370, 376 for long enough for a guy to make a decision and think about it. And I didn't. And now I'm running around unhedged on those. I didn't put on any LRP because, well, like one guy said the other day at this sale, he was waiting for it to get to 380. And it topped out at 376. And you're like, well, what was too good about 376 that 380 didn't bring? So that's why we're all sitting here learning every day and we're never going to actually know what the market's going to do in the future. And I think it probably is why some people sold when cattle were $1,800 on their way up from $1,200 and they missed out on a lot of opportunity that was ahead of them, but they had been burned before because they didn't put in their hedge at 376 and they waited for it to come down to 327 today, I think.
Yeah, it's only clear in retrospect. And the frustrating part about this is we're talking about the markets and is the high earlier this year, or is it going to be in 2027, or is it going to be in 2028? Well, by 2030, we will look back and it will be crystal clear what happened when the high was. And you look back and be like, well, this data was available. How come people didn't see it? But one day it will become crystal clear how this cattle cycle played out. And that day has not arrived yet.
I texted Logan the day that I no sale and I said, yeah, this is what I really want out of these. And this is what I got. And he said, imagine if you would have sent that text, was it 3 years ago or 5 years ago? You would have been like, what are we even talking about?
Yeah, you wouldn't even have known those were calf prices. Like 5 something for a calf. You'd been like, is this gas or what?
Yeah.
What are we talking about here?
Yeah. So it's amazing. And it's not impossible that in 5 years, we're talking about $7 calves or $9 calves. And I remember a time when we took 98 cents and then we ended up topping the market at 98 cents on some steer calves. And that was 10, 15 years ago. So in 10 or 15 years, are we going to be 5 times higher? Are we talking about a $25 a pound calf in another 10 to 15 years?
If they keep printing money, I'd sure bet on it.
Yeah, print another 100 billion.
But tell me what a pickup's going to cost.
Oh my God. It's a $500,000 truck.
Yeah, exactly.
That is really scary when you put it into terms like that. We're talking really quarter to $500,000 pickups.
Yeah, I think it's a reality in our lifetime.
I remember the first truck I bought, I was in high school, and I bought a new half-ton 1500 pickup, and it was like no bells and whistles, roll-up windows, and it was, I think, $26,000 in 2002. You can't even buy one without the bells and whistles anymore, but got a new truck now, you're easily 80.
Mm-hmm.
Easily 80.
Yeah, that's a good segue into working capital. Wes's question was, how do you think about working capital within your operation? I think this is going to be a great segment. You want to kick us off with, how do you view working capital, profit, disbursements to owners? What ladders take?
First I'll start off, and when we ran so many sheep, we had the same amount of vehicles we have today. We didn't sell down pickups because we go a lot of miles here, and we were trading a truck every 6 months. And we have not traded a work truck, a big diesel truck, since we sold our sheep. And we always allocated the trucks, tractors, everything when we were putting up hay, everything. We just split it 50-50 down the middle, and sheep paid for half, cattle paid for half. And it was hard to ever figure out really who was using this or that. And I will tell you, it's very interesting now, and having so many less sheep, how many less miles we drive, because our sheep operation's the most spread out of everything in terms of day to day. When we're in Nebraska, I'm not driving to Logan's once a week to check on things. But when our sheep are out north of the interstate, which is about 150 miles to our base camp out there, we were doing that easily once a week, sometimes 2 or 3 times a week. So when you're putting those kind of miles on, we were wearing out trucks and just on highway miles. And then you get out there and you be bucking snowdrifts for 3 hours, and then you get back on the highway and drive it home. So it's very interesting how we were allocating our overheads. And now that we're in a different place, it's easier to put everything more on the cattle side, and learned a lot about capital allocation there.
Doc Hazard, the OG in the stalker world, his line of thinking is you can't get ahead borrowing money. You've got to lend it to yourself. He grew through cash transactions, and I think there's some truth in that. Allen Nation says that going out and borrowing money on an animal that you're sure will increase in value is a good use of borrowed capital. I would love to be on the Doc Hazard side and buy everything with cash, but for me, it's not a reality. Like Eamon, I am not risk averse. I am risk tolerant. And so I feel comfortable with a lot of zeros attached to a line of credit or mortgage note. For me, I'm not as afraid. And we look really smart in doing that on this run up because we were a little bit more aggressive with our risk tolerance. I also had to borrow money for our cow herd expansion, which unlike the stalker, this is something I learned in growing the cow herd to sell. So I had to borrow money. We started that growth in late 2020, 2021. And unlike your stalkers where you turn them and burn them every year, with the cow herd growth, it was a multi-year capital tie-up. So I needed to borrow money to finance that. It wasn't dollar for dollar, but it was substantial. And it tied up that capital for several years. And it carried real risk. The cow market needed to go up for me to service the debt and to pay my bills. And fortunately it did. And I have been leveraged for most of my career here at Wineglass. And we got aggressive in 2016, and you can kind of see that chart just go up and to the right. And so I've been very fortunate in my timing. A different angle on that is we did have that land purchased in 2024, and we sold cows to finance that. And we purchased that ground with cash. And I could have mortgaged that ground and kept that cash for more working capital, so with less on our line of credit. But my dad and I really sat down, ran the numbers, and really were pretty adamant with the price that we had to pay, the interest rate where it's at, that it was a good decision to just buy that with cash. And also it was just kind of cool to do it, to buy something with cash, which you don't always get to do, but we just were in the right place at the right time. And that really ate down our working capital. But I'm really glad that I don't have that extra mortgage debt and that extra mortgage payment, because borrowing at what would have been 7.5 at the time, the interest alone on that mortgage would have been more than the rent per acre, just to give you an example of how backwards everything is. So that really limited our working capital, but we strategically made that decision. The money sat in our bank account for 48 hours before it went to close on the property. But there's two approaches for you, Weston. You really want to avoid going out and borrowing a lot of money on cows because it ties up capital for years. If you're sure they're going to go up, it is a good investment. Then Allen Nation would say borrowing money to buy a stalker is a great use of borrowed capital. And then lastly, Doc Hazard's philosophy, don't borrow money, period. Just leverage and lend it to yourself. And that is the only way to get ahead. So there's three opinions for you.
I 100% agree. Buying cows is all about timing. We purchased some cows in the winter of 2023 for $1,200, short-term cows just to be stocked for the incoming summer. The idea was we were going to buy them, calve them, breed them over the summer, sell the calf off of them, sell a bred cow. And as the prices kept going up, I just couldn't talk myself into selling these short-term cows because they were worth more every day. And we got a calf out of them that paid for that cow the very first year. And then she gave me another one. And every year that cow came through, and if she was open, great. I sold her for more than I bought her for bred. And every year that I kept one, I just got more and more calves out of them. And that ended up working out really well. And we still have some of those cows. I bought them for $1,200 with a calf inside of them. So that's worked very well. But the timing was right. And you have to hit the timing. That goes back to everything in this business. It's all about the timing. And I think in most businesses, I hadn't really thought about the way Logan said it, but we've probably been able to capitalize more on this run up with our breeding heifer program than a lot of people would have or could, because Logan and I, one, have large enough land bases to do that, and two, we're very risk tolerant. So we were willing to go in there and put down a lot of zeros on some paper and get a lot of cattle. And the other part is we've been good operators with them. We haven't had a lot of death loss or sickness or things like that run through them. And that comes from just a lifetime of growing up in this business. So the timing was good, our risk tolerance was high, and we had the land base to do it.
We were able to keep them running out for the most part.
Yeah, I have had to put cattle in a feedlot. Last year I did because they had such a great summer. The corn was late to harvest, so I had to go into a feedlot for a little while. But the market ran up so well that it didn't matter. I didn't make as much money as I could have, but it was negligible due to the amount of run up we had.
Timing is everything. Harlan Hughes extensively wrote about this back in the day in Beef Magazine. And I have printed off an article he wrote in 2019. And he really lays it out that when you buy a cow and when you sell a cow, when you get in and when you get out, trumps preg rate, weaning weight, all of these operational things that as managers we're worried about. He really shows and proves that timing is everything. And we just continuously come back to that. When do you allocate capital? Well, if your timing is right, get aggressive. If it's wrong, don't allocate capital.
And the other piece with the heifer is not only did I have the land base, I had the team behind me here at Ladder Ranch, and we were going to run something. So whether that was Logan's yearlings and my yearlings, putting cows on it, but I didn't get into a long-term expense on purchasing cows, especially in a high market. We're purchasing what feels like expensive bred heifers. This spring, we looked right when everybody was selling down, and because nobody had grass and they were so dry, I looked at it and I was going to lose $50 to $100 a head, depending on how you wanted to look at those numbers in the spring when all those big sales were happening, like in Torrington. But I had grass to come to, and it's amazing. As soon as those things went on grass, boy, that just slowly started to turn the wheel the other way. And you put that bull out on them, and boy, it just like explodes the value of that animal. So figuring out how to take that loss, which it would have been in the feed yard this spring had I not had grass, versus having a place to go with them and then starting to turn that wheel and really cranking that knob to 11 by turning the bull out with them and adding that huge extra value to them.
We've got to stock these places with something.
Yeah, you've got to charge yourself that fair market rent and all of those pieces. And that's one piece that I've been able to do a little better on these heifers than Logan, because I am running on federal land where my rent is significantly cheaper than a private land lease. And that's another component everybody needs to put in. And that's a real fair market rent because I'm really paying it. And that's what the government charges for that land. But you're able to do better on public land if you have the ability to use it than on private leases.
That's the one thing we're lacking at Wineglass. I want a BLM lease right next to me.
You can get one right next to you, then you're really cooking with gas.
Yeah. Unfortunately, it is not in the cards. Never going to happen. But I think about it from time to time.
Yeah, we're actually looking at some opportunities on public land piece. And if we were to get it, it is a long way from here. And the airplane would be absolutely necessary, but it would be a huge win on the books.
Yeah, and I hope you guys get it.
But I did talk to a guy that knows the country pretty well yesterday, and it's remote. It's remote for me.
You know how to deal with it better than anyone, Eamon.
We'll take it as it comes and we'll see what happens.
Weston's last question for us was, how do you look at allocation of overheads? Dallas Mount texted both Eamon and I saying, if you get into this, I'm going to reach through the computer screen and strangle you at your neck. And Dave Pratt's going to come in behind me and hit you over the head with a hammer. My dad went to Rage for Profit first in the 89. So really I've been a fan of the Stan Parsons model that Dave and then Dallas took. So pretty simply, Weston, we do not allocate overheads. I run an overhead report and I put them in categories, and it's one of the financial statements I deliver at the board meeting. It's a very critical report, and it's a very important thing to dive into, but I do think that allocating them to different enterprises is a fool's errand. The exception to that would be if like haying or farming, if you own a tractor, if you own a corn planter, you probably shouldn't take the expenses and depreciation on that and allocate it to your cow herd. So there are some exceptions, but for the most part, I like to view my overhead allocation as one monster and to try to tackle and look at that.
And in my previous story about when we have the sheep versus now where we have a lot less, we did try and do that. And we sat down and we hit that monster with Dallas in the room at our ranch. And it was a monster to tackle. And we've done kind of what Logan has done. And we've just kind of spread it over everything. And it's just too hard to break that down because you're using the same tractor for putting up hay, maybe as you're using to pull a deal to clean ditches, as you're using to feed heifers, to weaning, to feed cows before you wean. So it's just too complicated, and it's easier to do what Logan explained.
That time that you would spend in allocating, let's just shift that to analyzing and looking at what you can cut from it.
I think that there's a lot of truth to that as well. You can spend a lot of time, and they talk about it at Ranching for Profit, where you're spending so much time trying to figure out the pennies and the specific dollars, and you're missing the bigger picture of what are you doing it for? What number are you trying to get to that you're trying to solve? That's where you need to start, and then work your way back from there.
And it's such an important report to run. Post-COVID, that overhead, man, I did such a great job from when I took over 2012, 2013 to 2019 in keeping that number like that. But it's gotten high in the last 5 or 6 years. So run your overhead report, but just don't allocate them.
If I could go back and do one thing that would have made a huge difference in this ranch, is I wish that we would have gone to not haying, purchasing hay, selling the equipment, and let's call it 2019. Let's just pretend I could have done everything perfect. And we would have done that in 2019 instead of 2024. We would have made so much more money because we kept playing that game of we got to get a new baler, we've got to get a new rake, and we're putting up hay, and the cost of hay relatively wasn't that high then. In 2023, it did get high because of the big winter, but in general, what we spent on equipment, depreciation, we could have definitely made up for that and done so much better if we would have sold in 2019 and got into the intensive grazing and quit haying.
Maybe we should hit on that next episode. I think that'd be a good one. We're looking at our farming enterprises and just scratching our heads currently, and there are a lot of people doing the same. Maybe hit on that earlier just for the farmers. But the ranchers, I think, would be a good use of time to look at an enterprise that is struggling and what do you do and how do you manage through it, because it's just not working at all. So I think that'd be a good one to hit on.
Would you like to hear a fun number?
Yes.
If you're a cow feeding guy and you do what Ladder Ranch has done for generations and fed cows and you put it up all summer and kicked it out all winter, before you pay for the tractor, before you pay for the employee to go kick it out or your time, it is $6.16 to feed a cow a day all winter.
Wow.
Yeah. So when you talk about going to a feedlot in Nebraska and putting the trucking under, all the things, you could send that cow a long way.
You could probably send her to Illinois.
I could probably send her to Southern California and graze, fields like people do with sheep down in Southern California to even come close to that number. But you can go into a feedlot for $2, $2.50, $3 even a day, and you're still half of 616. So I would caution anybody with hay right now, not a bad idea to sell that hay at these high prices and go find a place to put your cows and put some trucking under them, because 616 a head a day, I think, was at 3.25, 350 a ton.
I'm glad you floated that number out there because I wouldn't have guessed that within $2.
When we ran it, I was like, that can't be right. And I ran it 3 different ways and it kept coming back. And I'm like, oh my God, that's what it is. So anybody out there getting ready to feed cows all winter, I just caution you to know what the real number is. And there's a lot of people that want to buy hay right now.
Yeah, run your numbers.
With that, Logan, I think Weston sent us some awesome questions, and I very much enjoyed this episode. This was fun to talk about and fun to dig into why you and I do things the way we do them.
Well, if you have any suggestions, reach out, and we're excited to get into it next week. Keep running on grass.
Adios.